Hello, everybody. Thank you all so much for joining in today. Really excited about this lab, this next level lab, as we've been calling these conversations. And so glad y'all are taking some time to be with us today. I am really excited for those of you who have not had the opportunity to meet my favorite Australian. I think I can say that with integrity. I know several Australians. Chris Pratt. Chris Hemsworth, is he Australian? I don't know. I've never met him though. Anyway, Nick Setchell, by far my favorite Australian, definitely the smartest one I know. We are really excited about this conversation because of its practicality. This speaks right to the core, to the bullseye of the target of the businesses that we're leading and trying to build value in. So being able to measure and manage our business strategically is part of our responsibility. As Nick is quoted as saying, we want to be value creators, not busy fools. And if we don't have solid metrics or ways of measuring that, then we don't know if our strategies are actually working. And so we spend a lot of time chasing shadows or doing a lot of guessing. And so what we're passionate about at the Edmondson Group and Next Level is your energy as a leader, as an owner, as an executive is finite. You only have so much of that to go around. And if we can help direct and focus that energy on things that you're not having to guess at, where you can have some objective and definitive intelligence right at your fingertips, then that's empowering, that's energizing to you. It helps you focus your creative leadership energy where it needs to go. So, Nick, I'm really glad. Nick is it's like 2 a.m. there, so he has rolled out of bed, cleaned himself up, and gotten ready for this call. So thanks for making the sacrifice to be here with us at such an early hour for you. Really glad to have you.
My pleasure.
The way we introduced this conversation was provocatively just saying that your traditional accounting is not helping you build value or add value to your business. So maybe start by telling us about yourself, your background, and then why we would make a statement like that.
Sure. Thank you, Shannon, and welcome everybody. So my background, I did a degree in economics at university. And after that, joined the accounting profession, which back then was the Big Eight, which gives you a bit of an indication of how old I am, because now there are only 4 left and they seem to be dropping like flies. Joining the Big Eight, I had an opportunity to work in the audit department. Many people would consider that a pretty boring place to start your career. But actually, if you stop complaining about how boring it was and opened your eyes, you actually could learn a lot about the way businesses are measured. At a relatively early age, you got introduced to quite large, often public companies, and you got to see lots of different elements of the business and how it was measured. But what it also taught me was, what the opportunity also gave me was to get my professional qualifications in accounting. I only stayed in the accounting profession for a little over 3.5 years because quite quickly I worked out that what excited me was running businesses, not measuring businesses. And I had an opportunity fairly early on in my career to move from the accounting profession into running a branch of a software company. And it was a bit of a baptism of fire. I was fairly young at the time, and I learned some lessons very quickly. And the first lesson that I learned was that very few people who did not have accounting training really had a decent understanding of what financial statements were telling them. If you've been fortunate enough to go through a degree in accounting and then qualify with postgraduate accounting qualifications, then you can probably interpret the traditional output of an accounting system. But if you haven't, it's extremely difficult. And that lesson very, very early on in my career started to challenge me in the thinking about what numbers businesses should use to help them run their business. And really that was the starting point, if you like, of taking a very different view of how we should use numbers. And just as importantly, understanding that the vast majority of the information that is produced by the accounting fraternity, whether it be internal or external accountants, is not understood by the people it's produced for. And that then challenged me to start thinking about a different way of using numbers to measure business, so that our clients, first of all, the businesses I worked in and the leaders of those businesses, and then later in my career, our consulting clients, could get better information out of their financial information.
So, and I think you said several things in there that are worth spending a little time on. One being the financial data that we're getting is not understood, or often understood, by the people it's produced for. Say more about that, and maybe speak to the of why that traditional accounting, what we're accustomed to seeing, isn't serving us maybe as well as we think it is.
Indeed, I will. And may I say in the first instance that this is not business leaders and business owners' fault. It's an onus put upon them by the accounting profession that assume that the information that they're producing is going to be useful. But let's go right back to the beginning of the process and let's challenge that premise, because traditional accounting was never set up to be a tool to help you run your business. In fact, if anything, it was more of a regulation tool or a transfer of capital tool. So let's just talk very quickly about some of the history of traditional accounting, because some people don't know this. So the fundamental central element of accounting is a process called double entry bookkeeping. Now, this is where it gets rivetingly exciting, Shad, and I imagine that your users are now on the edge of their seat, thinking this is going to get exciting when we start talking about double entry bookkeeping. Some people think that double entry bookkeeping was invented in 1494 by a Franciscan monk called Luca Pacioli. And indeed, Luca Pacioli did develop and define some of the modern elements of bookkeeping. But the derivation of bookkeeping goes back well before that, 7,000 years to some of the early civilizations that used recordings on clay pots to look at transactions. But the element that I want to raise, which I think is more interesting, relates to the Knights Templar that I'm sure you've heard of and most people have heard of. There are lots of fabulous books around about the Knights Templar, and they, of course, lived in the 12th to the 14th century. And they were active in many of the holy wars of that time in Europe. But what you may not know is that they were also active as some of the people who controlled capital movement across Europe. So if you wanted to move a bag of gold from, let's say, London to Rome or London to Paris back then, the last thing that you would want to do is carry it with you, because you'd probably be robbed. So what you would do back in those days is you would go to a Knights Templar in London and you would give that Knights Templar your bag of gold. They would then write a coded note that you would carry with you that in itself had no value unless you knew where to take it at the other destination. So you'd be given a coded note and you'd be given an address. And you would go to your location in Paris where you would visit another Knights Templar, hand in your coded note. It would then get decoded and they would give you back a bag of gold, less, of course, the fee for the service. The code that they used was double entry bookkeeping. Now, why do I raise this at the beginning of this podcast? Because it was a code. You weren't meant to understand it. In fact, ideally, it was meant to be so confusing you couldn't possibly understand it. What we then see in the development of bookkeeping in 1494 was the Franciscan monk Luca Pacioli turning it into a more defined, a more understood code, but it's still a code. Wind the clock forward to the modern day. And what we see today is the modern derivation of bookkeeping, which is a system that produces two documents, an income statement and a balance sheet. Now, has the accounting profession ever stopped to think that when they're giving out two documents, that they're teasing the audience? here are 2 documents about your business. And the audience is sitting there going, couldn't you just give me 1 document that tells me what's going on? Why do you have to give me 2 documents? And that becomes even worse when we consider that one of those documents, being the income statement, is relatively easy to understand. You don't need a lot of training in understanding an income statement. You've got your revenue at the top, you've got your costs underneath. Try and make sure your revenue's higher than your costs. I think most of your listeners have already got that message. Then you've got the other document, which is the balance sheet, which is a highly confusing document. It is a raw numbers dump that puts the positives at the top, assets, the negatives in the middle, liabilities, and the difference at the bottom, equity. It's not designed to be a useful document. And if you've not been trained as an accountant, it's incredibly difficult to interpret. So what does that mean? What does that mean for your average business owner trying to interpret their information? They will, of course, graduate to the document they understand, being the income statement, and they will probably assess their business on 2 numbers, the numbers at the top and the numbers at the bottom of the income statement, which are revenue and profit. Now, those numbers are important, but they only tell you half the picture. And if you rely on only half of the picture, you are running an elevated risk. Traditional accounting was never set up to help you run your business, period.
I did not know that we were going that far back historically to introduce this, but you took us. I
understand, Chad, that in America you think history is only 400 years old. In Australia, we think it's only 200 years old, but apparently elsewhere in the world, history does exist even further back than that.
But not the metric system. Just history.
Let's just put that aside, because one day the US will catch up on that as well.
Okay, so this just laying the premise. And by the way, if you guys have questions and want to pose those in the chat, feel free. I'll be monitoring that. Would love to hear anything, questions that come up. We'll try to make time to cover those. But so the fact that the traditional means of reporting was never meant to help us manage our businesses has left us to do what? So now we take what we've got, and for many of the people that I talk to, the business owners that we work with, there is a somewhat often unspoken sense of insecurity around our financial aptitude. And so it doesn't really get talked about. And again, there are certainly some people that understand it far better than others, but I think the vast majority of us feel a little bit insecure around that. So what does that then produce? What does that cause us to do? How does that impact our behavior and our leadership?
Excellent question. It produces stress, it produces bad decisions, and it produces underperforming businesses. Let's talk a little about, nothing overly serious there, is there? Other than the fact that if you want to be successful in business. So let's talk about stress, first of all. And this goes right down to the heart of how most businesses run their leadership meetings, which I think is also fundamentally flawed. And this is driven by the traditional accounting process. Far too often, the meeting will start with somebody tabling the financial statements and saying, right, let's have a chat about how we went last month. I think that's a ridiculous way of starting a leadership meeting for 2 reasons. The first is the reason I've already identified, which is those documents were never designed to help us understand the business. But secondly, we have no context to interpret the numbers. Even if we understood the numbers we were being given, we have no context. So what will often happen in that situation is that somebody with a strong personality will run their finger down the expenses component of the income statement, and they'll find something emotional. It'll be travel, entertainment, advertising, or chocolate cookies. And they'll start complaining about, how did we spend so much money on this area here? Now, I guarantee to you, it's very unusual that any of those things will ever be the make or break of a successful business. But they will end up being the emotional lightning rod that occupies too much of the conversation. The meeting will descend into operational firefighting, and then people are charging out the door to put out these ridiculous fires, and little or no time or headspace is then spent on the more important issue, which is strategic conversation. What's changing? How are we going to respond? What are the numbers telling us? So what tends to happen in the early phases of those meetings when there's the review of the financial results is that the people around the table that don't have training in accounting get quite stressed. It then results in them not really understanding the numerical position of the business, so they therefore don't have a particularly effective conversation. If they don't have an effective conversation, they don't make good decisions, or they make decisions with only a small part of the information, and that contracts their ability to create value. Now, I want to talk about something else here, which I find quite disappointing. And please understand that my postgraduate training is in accounting. So I've been through all of the training that accountants go through. There has been little or no development in the way the accounting profession have handled these conversations for the better part of 400 years. Wouldn't you think if your customer base was consistently telling you that they struggle to understand what you're saying, that you'd find a different way of telling them what you're trying to say? But no, the accounting profession haven't. They have religiously stuck with the format that they have used. In fact, the most significant transition that's happened in this space was probably approximately 90 years ago, and that was driven by engineers. When the engineers at the DuPont company challenged the accountants to explain what a balance sheet actually meant. And what they then found, engineers being numerically astute people, not trained in accounting, but numerically astute people, is they then came up with a different way of interpreting a balance sheet, not just a numerical raw dump of data with the pluses at the top, the minuses in the middle, and difference at the bottom. But the DuPont engineers, under a process that is now called DuPont analysis, came up with a way of looking at the balance sheet that understood that every element either funded the business or operated the business. And that transition actually made the balance sheet, when it's recast into a DuPont format, a much more valuable tool. But do you think the accounting profession have adopted that? Absolutely not. In fact, they get a bit frustrated with the engineering profession for dabbling in their space. So the accounting profession just hasn't changed. What they have sometimes tried to do, which I find quite interesting, is introduce a role called the management accountant. So you've got the financial accountant or the compliance accountant over here that complies with the law, and then you've got the management accountant that helps you understand what it all means. But what I've observed, having seen hundreds of businesses go down this track, is that the management accountant will end up producing a management pack, which is often 50, 80, 100 pages deep and very thorough and very accurate. And often when I'm asked to review management packs that are sent out, the first question I ask the accountant is to what degree do you think your leaders understand this information? And they say, oh, not really at all. They tend to just read the top page. So I say, well, what was the point? You put an enormous amount of effort into something that hasn't generated a conversation. The only reason we calculate numbers in the process that we use, Shad, you, me, and Ken use, the only reason that we calculate numbers is so that those numbers generate a conversation with better understanding, and then an action, and that action is going to make tomorrow stronger than yesterday. If your calculations and your numerical process is not well understood, does not generate a conversation, does not generate actions, it has failed as a management tool.
And I want us to come back to the DuPont analysis component. However, before we do that, talk a little bit more about the context we create when we're just relying on month over month and kind of the 12-month calendar and setting the budget, like our traditional kind of customary approach to going about setting up our year and our months and then measurements that we're using. Why are those not as effective as they ought to be?
Well, now you're raising the next issue, that not only is the structure of the information ineffective, but the time frame that it relates to is not particularly effective. So let me share with you a couple of different ways of measuring business. There is what is called the year-to-date mechanism, and this is by far the most common and by far the least effective. The
Right.
year-to-date mechanism starts with a date, typically in the United States of America, the 1st of January, with your income statement set at zero. So revenue at zero, expenses at zero. And then through the year, you measure your performance. And each month, you can produce a monthly income statement. And typically in that monthly income statement, you'll get the single month, and then you'll get a year-to-date. That's the most common way that businesses are measured. Why? Because most accounting systems are set up that way. And at the end of the year, lines drawn in the sand so governments can tax us. That we all understand that that's the reality. But the problem with relying on data in that format is that only once a year, being the end of the year, have you got a complete 12-month data set. For 11/12ths of the year, you're operating with an incomplete data set, which can be very, very dangerous in terms of understanding your business. And in fact, it could be argued that even at the end of the year, once you've got your 12 months, you've not got a complete data set because accountants still reserve the right to do year-end entries many, many, many months later. So you could argue that you're never actually using a complete data set. Had there's another problem with this concept. Let's say that here we sit on the 3rd of August, and let's say that we had a system that was incredibly efficient, and we'd been able to close our July data, and we had our July financial statements in front of us on the 3rd of August, which, by the way, would be incredibly fast, and very few businesses we've looked at have ever been able to close that quickly. Most businesses close between the 15th and the 20th day of the month. But let's say you're an astonishingly efficient accounting system and you are able to produce your financial statements on the 2nd or the 3rd day of the month. Now, here's the problem. The financial data that you're looking at in those July statements on the 3rd of August reflect the actions that you took 90 days ago. Now, I want to express that a slightly different way because this is an incredibly important point. If you make a significant change to your business today, it's likely to take 90 days before that change is reflected in the numerical results. Let's say, for example, you choose to put your prices up today. You start quoting at the new price, you start delivering work at the new price, you invoice the new price, you collect the new price. That might take 90 days to have any impact on your numbers at all. So if an action today takes 90 days to show up in the numbers, it is absolutely logical to understand that the numbers you're looking at today are showing you what you did 90 days ago. At best, the traditional accounting process, hard as it is to understand, and ineffective as it is to tell you what's actually going on, at best, it's giving you a history lesson of what you were doing 90 days ago. If you want to change your business in 90 days' time, you're going to have to change your process to become more strategic. And I want to give you an analogy to really try and hammer this home. This process would be akin to driving an automobile, to driving a vehicle with your windshield blacked out, and relying on a slightly hard to see, slightly fuzzy rear view mirror. Nobody in their right mind would drive an automobile that way. But the vast majority of businesses are driving their business that way. I rest my case.
That's a strong visual. Blacked out windshield and relying on the rearview mirror to drive forward at high speeds.
And we haven't even got to talking about forecasting yet. Don't get me started on that, or maybe you should.
No, I wanted to talk about the other things that were coming to mind. You know, when I think about budgeting, when I think about valuation of like EBITDA as an example, which seems to be the, you know, all the craze in terms of a metric and forecasting. So how, you know, because that model, the traditional model, to start there, how does that impact our forecasting? How does that impact the way we value our business and performance? The month-over-month comparisons, which we seem to live and die by. So all those things then are extrapolated from this traditional approach, but they all have their own set of problems. So talk us through those.
So you've raised about 1,000 different issues.
I know. I need help. We need help in all of them.
You would be an astonishingly good journalist, Shad. I've got to say, you've raised about 1,000 issues there. Let's deal with forecasting first of all. And there are many different words associated with that. One of the more common is what's referred to as traditional budgeting. And traditional budgeting is done either at the end of the previous year or at the beginning of the year, and typically goes out 12 months to the end of the financial year. Now, that alone is flawed. It's a flawed process. And you've heard, and I've heard many businesses who basically said, look, we've given up on budgeting because it doesn't work. We spend 4 weeks putting our 500-line budget together, and it's ever so complex, and we send it off and we get it approved by the board. 30 to 45 days into the year, the landscape's changed, and all those assumptions we made to produce that budget are no longer valid. So we spend the next 10 and a half months struggling with this budget that's out of date and doing this fabulous process that we call budget actual variance analysis that only comes about because there's new information that didn't exist when we built the budget. What an astonishing waste of time. And the other problem that you've got with traditional budgeting is it tends to only look to the end of the financial year. So as you work your way through the year, the distance that you're looking forward is shrinking until such time as you build your next budget. Now, I want to use another motoring analogy to highlight how ineffective this is. When you're driving a car at, say, 60 miles an hour, did you notice how naturally I just clicked into the old system there?
You're so American. You're so American.
When you're driving a car at 60 miles an hour, you may or may not be aware of the fact, in fact, most people do it naturally, so you're probably not aware of it, that you are looking and you are conscious of a field of vision about 120 yards in front of the car. And as you move down the road, your field of vision moves with you. And all of these different things that come into that 120-yard field vision help you make decisions on driving your motor vehicle. What you don't do is you do not start with 120 yards of field of vision and allow that field of vision to shrink to the point where you're looking only 10 yards in front of your car, because that would be ridiculous. You'd most likely have an accident. But that's exactly what you're doing in traditional budgeting when you've got your budget up to here and your actual date's getting closer to it. And it's only when it gets really close to it that your budget bounces out another 120 yards. So that process is ineffective. The process of assessing that you can predict every landscape change for the next 12 months is ineffective, particularly right now, because as you well know, we live on a rapidly changing landscape. I mean, people are getting sick of hearing about the rapidly changing landscape, but the fact of the matter is it's changing more quickly today than we've ever seen in our life. So traditional budgeting doesn't work. So what we then have to adopt is a process that I refer to as forecasting, and forecasting and budgeting, I do think are different. If you need to set up a traditional budget to get it signed off by the board, do it, because the board's going to want it. But if you want to be an effective leader, you need a forecasting process that challenges you to challenge the landscape every month. And I'm a big fan of the question, what information's come to light in the last 30 days that changes our view of the future? And having the leadership team answer that question each month and then reassess their forecast based on new information that exists today that didn't exist yesterday. And not just reassess their forecast up to the end of the financial year, but keep their forecast 12 months ahead of their business or 120 yards ahead of their car. So traditional budgeting versus rolling forecasting, it's as simple as this. Traditional budgeting no longer works, and most people have given up on it because it's too frustrating. Rolling forecast, incredibly effective. And in essence, what you're doing is you're instilling the concept of strategic planning into your monthly leadership culture. Because like traditional budgeting, once a year strategic planning is less effective if the landscape's changing rapidly. So I hope that deals with the forecasting / budgeting element of the conversation. You also raised the concept of valuation, and you used a word that I'm not fond of. You used the word EBITDA, and you may have seen my eye just twitch a little bit.
I say it just to get that twitch. I just like to see it happen.
I'll tell you what, you know how to get me riled up. So EBITDA has been a predominant measure used in valuation, and there are still many valuers that use it today. It's also a measure that has been used widely by the banking profession over the past 2-3 decades, and there are still bankers today that talk a lot about EBITDA. So let's not dismiss the fact that there are people who are going to be looking at your business who are going to want to know all about EBITDA. But before we get too excited about whether EBITDA is the correct measure, let's look into the history of EBITDA. And I'm sure, Shad, you're familiar with the history of EBITDA, as indeed you were with the history of bookkeeping.
Yeah, not going back to the 15th century, but educate me.
For this one, we're only going to have to go back 30, 40 years ago to the bonding era, to the environment where the amount of money that you could borrow from a bank was determined by a multiple of profit. And if you could make your profit look higher, then you could borrow more money. Now, that also fed into what was referred to as the dot-com era, and we all know how well that went. But if you could make your profit look higher, you could borrow more money. So what's one of the ways of making your profit look higher? Well, first of all, what's the best measure of profit? The best measure of profit is a measure called EBIT, earnings before interest and tax. It's before interest because that's a funding cost, and it's before tax because that's a non-operational element. So EBIT is a very valid starting point for your profit calculation, and in fact is the basis of the profit calculation we use in our process. But how could you make EBIT look bigger if you wanted to borrow more money? Well, you might well say, well, here's an idea. Let's take out depreciation, amortization. Let's remove those costs so our profit goes up so we can borrow more money. And we're going to remove those costs because they're non-cash items. Well, okay, if you want to go down that track, what about provisions? What about accrual? Why don't we call this EBITDA par? EBITDA par. Because the more stuff we can take out, apparently the more money we can borrow. But we all know where that's going to lead. So here's the reality about EBITDA. It's an ineffective measure that gets both profit wrong and cash flow wrong. One of the things that often said about EBITDA is we use EBITDA because profit is not a true reflection of cash flow. Well, what an ignorant comment. Of course, profit's not a true reflection of cash flow, but rather than using a hybrid measure that gets both wrong, why wouldn't you measure profit correctly and measure cash flow correctly, which is, of course, what we do. So EBITDA's foundational reason for being is flawed, and more environments are moving away from it. So the banking profession, or the more sophisticated modern banking profession has moved away from EBITDA because they recognise that it's flawed, and even the valuation profession is moving away from EBITDA. Now, I reiterate that you will still hear a lot of people in both of those industries use the expression, so you can't ignore it, but you also have to understand that it's flawed. The more sophisticated valuation profession today is calculating not just a multiple of EBITDA, but in fact the net present value of the future cash flow stream. Now, as I use those words, half of the audience is going, yeah, what? What did he say? The net present value of the future cash flow stream? That sounds complicated. Yes, it is, but it's more accurate. So before we jump to the conclusion that EBITDA is the most important thing for us to be looking at, I'd like to throw up an alternative. Let the external parties, whether that be the valuers, whether it be the bankers, whether it be the tax planning experts, let them do their job, and you don't have to fully understand the mechanics behind what they're doing. But what you have to understand is that if you can provide them with a solid business that from an operational perspective is getting stronger, then your value's going up, your relationship with your bank's probably getting better, and your tax planners have probably got more work to do. So don't trouble yourself with metrics that don't come into your domain because you half want to understand what they're thinking about. Focus on what you can influence, which is the operational decisions in your operational environment. And the better you do those, the better everything else looks. So when we start talking about value, and may I strongly state that our process is not a valuation process. It's a process to help you create value. And that might seem like a fine line, but it's a process to help you create value and mitigate risk. So what we do is focus on the operational elements of the business and make sure they get stronger by making good decisions following good conversations. And if you do that, your valuation will go up. And if you are also using an effective form of forecasting, your ability to see the future gets significantly stronger. And I have to tell you, Shad, that as a leader, when you've got the ability to see the future, you have a tremendous advantage over your competitors.
have you seen, or do you see when people are relying too heavily on EBITDA as the measure of value, that they're undervaluing oftentimes their businesses, or not, at least not properly capturing the full scope of value?
I think you could take that position, but I think the more effective position is that you're focusing on the wrong things that are going to increase value. And if you're focusing on the wrong things, if you're arguing, for instance, about the depreciation rate of an asset, as opposed to actually focusing on your pricing philosophy or your margin control or your accounts receivable collection or your inventory management, then if you're focusing on the depreciation of an asset to change your EBITDA, you've missed the point. And you're wasting your energy on something that isn't going to help you increase value.
Yeah, that's really good. That's a really, really big point. Okay, so we talked about a lot of things, and again, if y'all have questions, feel free to fire away. Nick is a master in this territory, and many others too. But right now we're focused on this one. So you brought up earlier the DuPont analysis, or the DuPont methodology. Can you explain that in a little more detail about how that compares or contrasts? And I know we've touched on some of those principles, but how that compares and contrasts to a traditional approach?
So 90 odd years ago in the DuPont leadership meetings, what was happening is much the same as what's happening in many leadership meetings today. Accountants were walking in with their two documents, income statement and balance sheet, which we've already defined as an ineffective way of producing information, putting them on the table. And the engineers, who are numerically bright people, would pick them up, they'd read the income statement, understand it, have a chat about it, pick up the balance sheet, get completely confused about it, push it to the side. And one day, one of those engineers put their hand up and said, look, I've got a question. I know this is going to make me look a bit stupid, but I've got a question. This second document, I don't understand it. I'm assuming it's important because you keep giving it to me, but I don't understand it. Is there a better way that you could tell me the information that's on this second document? And what they did is they sat the accountants down and they made them explain in plain English. In plain English, that's something that we talk a lot about, Chad, in our processes, keep things simple. They made the accountants explain in plain English what every single element of the balance sheet actually meant. And what that enabled them to do is then develop a different view of the balance sheet, not just an assets minus liabilities equals equity view, but a how do we fund the business? How do we operate the business? And one of the challenges I often set to accountants on the rare occasion I choose to talk to groups of accountants is I'll give them a relatively simple balance sheet and I'll say, okay, tell me how much is invested in this business. I mean, it's an incredibly important question, isn't it? If you want to get an understanding of how much value you're creating, perhaps the first thing you might want to understand is how much is actually invested in the business. Almost never can accountants get the answer to that question right because the traditional balance sheet isn't set up to do that. What the DuPont balance sheet is set up to do is tell you how much is invested and furthermore, how much of it came from the owner's own money being equity and how much came from debt, which is the debt to equity factor that the bank's going to be looking at quite closely. But the DuPont balance sheet doesn't just tell you how much is invested. At the top part of the DuPont balance sheet, it tells you how the operational leaders are using that investment to operate their business. And fundamentally, that comes down to four areas: accounts receivable, inventory, fixed assets, accounts payable. So it focuses us at the areas of the balance sheet we need to pay attention to. In my experience, good leaders have got a pretty good handle on their income statement, the revenue and the expenses, and they're managing that. If we can get them to focus on receivables, inventory, payables, fixed assets, then they've basically taken control of the things on the balance sheet. They need to take control of everything else to take care of itself. So the DuPont balance sheet, or the recasting of data into a DuPont balance sheet, was a major step forward. Now, once you've done that recasting, the calculations you can do are going to be more valuable, they're going to drive better conversations, and they're going to result in better actions. And the calculation at the center of DuPont analysis is a calculation called return on capital employed, or ROCE. And it is deemed by public companies to be the most valuable measure of management performance that you can get. The problem is, in the hundreds and hundreds of presentations that I've given to groups of mid-market and private company leaders, I would ask the question early on this journey. I'd say, how many of you use Roki to understand your business and make better decisions? I would be lucky in a group of 15 if one person put their hand up. So I then followed it on with the second question, which is, why don't you use Roki? Public companies are telling you that it's the most valuable measure to assess management performance. Why don't you use it? And I would get all sorts of answers, from the brutally honest, never heard of it, right through to it was too complicated. And it is, by the way, of course it is. It's designed by engineers that love making things complicated. But anyway, probably a good thing, because that's why bridges stay up. So let's just leave that alone. Sometimes you get an answer in the middle that says, look, I tried it and I couldn't quite get it to work. But what I would consistently say is, don't give up on this concept. I didn't, and I don't want you to. So what I actually did was I wound the clock back 90 years to the original DuPont research, and I took it apart piece by piece by piece. And then I put it back together again, piece by piece by piece, but in a simplified manner that could be easily applied to private and mid-market companies, which are subtly different from public companies. So basically, recreating a version of Roki that worked well for mid-market companies. So much of the work that we do when we analyze businesses is on the base premise of DuPont analysis, which is the most effective way of assessing management performance.
So one of the things you touched on, and I don't know if these two, I don't know if I've asked you this before, but when we were looking at, we talked a little bit about the rolling 12 and kind of a rolling forecast. Is that a part of the DuPont process, or are those two distinct principles?
It's not. The DuPont process recasts the financial statements to enable you to do calculations that make more sense. But when DuPont originally did it, they still did it on a year-to-date mechanism. The rolling 12-month process, which has probably been around for about 20 or so years, is really just the desire to always be looking at 12 months of information. So basically, you restructure your raw data into DuPont format, and then you apply the rolling 12-month process to it, and then you do your calculations that tell you how strong or weak your business is. And if you do the right calculations and have the right conversations, very quickly you get to the heart of the matter.
Really good. Any other aspects of the DuPont analysis that, or measurements or metric that become easier for us to see and to measure when we're trying to manage and lead? Anything else become all the more obvious?
Not really, other than saying when you understand the numbers more clearly, the messages become clearer and the solutions become clearer. I suspect that if we want to go into the details of the particular calculations we do, we should do that in a different podcast.
Right.
But I think what we've really established today is the need to move away from traditional accounting, the need to move away from year-to-date accounting, to get our information into a format that enables us to do calculations that help us understand our business, have conversations, and make decisions. And that is never going to be done easily or effectively using the traditional accounting process.
Well, I haven't done nearly as many of the reviews as you have, but I've done enough to have seen and I've heard enough from our clients and from fellow leaders that to normalize the frustration we feel when we're trying to more accurately measure and report, and the things we chase and the reporting that we develop to try to help us tell a better story or to tell us the accurate story. So that frustration is pretty normative across the board from all the people that I talk to, where we're working really, really diligently to try to determine if what we're doing is actually moving the needle in terms of creating value. And so what I love about our process is that it's much more definitive and a lot easier to measure and report on. So I just want to, applaud you for the work and effort and your passion behind this, because it's obvious Nick brings as much energy to every single client that I've been with him on, and every presentation he makes. And I've seen business owners in near tears, not realizing how well they were doing. Like when they start looking at the data and going, I didn't know, I was just afraid. I just kept pedaling because I didn't know we were doing this well. I'm not even sure how we got there. So, and the other side of true of, not knowing how to get out of the hole they're in.
And sometimes, Shad, that extending that second point you made there, understand they inherently know something's wrong, but they don't necessarily know where the issue is or how to fix it. So if you can lay that out with clarity, then there's enormous relief that all of the effort that they've put in can reward them with a good outcome. They just need to fine tune some things, and they weren't getting those answers before.
Well, thanks so much for your time. Did anybody have any questions before we let Nick go? We will definitely do this again as a follow-up to this conversation and do a little deeper dive into some of our process and how we bring DuPont analysis to bear. All right. With no further pressing questions, we'll let you go, Nick, and get your day started, or maybe go back to bed.
One of the two, Shad.
One of the two.
Thank you, everybody, for joining us. I hope you found this interesting. I think next time what we should do is dive into the specific numbers that we should be looking at to understand our businesses, and that can be a topic for another day.
Yep. Look forward to it. Thanks, Nick. Thanks, everybody.
Take care. Bye-bye.
Bye.